Imagine sitting in a courtroom watching Elon Musk's lawyers argue this massive, really philosophical case about the future of artificial intelligence.
Right, the OpenAI trial.
Exactly. Normally, you'd have to wait weeks or even months for a jury to deliberate and actually hand down a verdict. But instead of waiting, you can, just look down at your phone right in that moment and watch 10,000 day traders updating the exact percentage chance of Musk's legal defeat.
Yeah, second by second.
Literally second by second.
Yeah.
With millions of dollars of their own money on the line.
It completely changes the way we understand current events. I mean, when you force thousands of independent people to put their own capital at risk to forecast an outcome, well, the individual biases, the blind spots, and all that wishful thinking,
It just vanishes.
yeah, it tends to get burned away by the financial exposure. You are left with this surprisingly sharp, dynamic picture of reality. Prediction markets are, in a lot of ways, the ultimate truth tellers.
Because they cut through the noise.
Right. Exactly. They cut straight through the PR spin, the corporate press releases, and the political grandstanding. Because when a trader is risking their own money, they really do not care about the hype. They only care about what is statistically likely to happen.
Which brings us to today. Welcome to today's deep dive. Today is Wednesday, May 13th, 2026. And our mission today is to examine a fascinating stack of data from these prediction markets, specifically looking at platforms like Polymarket and Kalshi.
Lots of really interesting movement on there lately.
Oh, for sure. We're going to see exactly how this modern iteration of the wisdom of the crowd is pricing in the reality of our technology, our sports, and our global politics. The vibe of our sources today is a theme we are basically calling institutional realism.
I like that term.
Yeah, because we had all those wild hype cycles back in April. But now we are translating major global events into cold, hard probabilities. For you listening right now, consider this deep dive your shortcut to being incredibly well-informed on what the world's most hyper-focused forecasters are anticipating next.
And there is a lot to anticipate.
So let's jump right back into that courtroom in Oakland. We are currently in the third week of testimony in the trial between Elon Musk and OpenAI, and the markets are aggressively reacting to it.
Aggressively is almost an understatement. The shift in sentiment is one of the most drastic we have seen all year. I mean, this was initially framed as a battle for the soul of AI, right?
Right.
But the traders on these platforms, they are stripping away the philosophy. They are focusing entirely on the raw legal mechanics of what is actually happening on the stand.
Okay, let's unpack this because the shift is staggering. We are looking at Kalshi's data on Musk's probability of prevailing, meaning, winning on his core breach of mission claims. Just last week, he was sitting comfortably at a 58% probability of winning.
Solid favorite.
Exactly. But looking at the tape today, that has tumbled all the way down to just 39%. The crowd is suddenly betting heavily against him.
It's a massive drop.
And this 19-point drop correlates perfectly with the judge's dismissal of several fraud-related counts. But the real catalyst seems to be the release of these internal diary entries and the testimonies from former executives.
Yeah, those diary entries really changed the temperature of the room.
It feels like a messy public breakup where private text messages, or in this case, diary entries, get leaked, and suddenly the crowd's sympathy entirely shifts. It went from looking like a grand philosophical battle to something much more petty.
It really did.
But I have to ask you, is the market looking at this as a moral judgment on the ethics of AI development? Or is this purely a clinical assessment of corporate law regarding OpenAI's highly controversial shift from a nonprofit to a for-profit entity?
What's fascinating here is that the market explicitly does not care about morality. It only cares about liability.
Liability, right.
Yeah. To understand why traders tanked Musk's odds so fast, we really have to look at how corporate intent is structured under the law. Let's use an analogy. Imagine a neighborhood charity bake sale that suddenly, overnight, declares itself an aggressive Wall Street hedge fund.
Okay, I'm picturing it.
If you were an original donor to that bake sale, you would probably sue for a breach of mission, right?
Oh, absolutely. I wanted to buy cookies, not derivatives.
Exactly. But to win that lawsuit, you need to prove a clear-cut legal breach of fiduciary duty. You need paper trails showing deliberate deception regarding the original corporate charter.
And what the traders are seeing in these diary entries doesn't look like deliberate corporate deception.
Far from it. When traders look at those internal documents and hear those executive testimonies, they aren't seeing a calculated breach of a nonprofit charter. They are seeing basically interpersonal friction.
Just people not getting along?
Right. They are seeing a PR battle between rival billionaires who just deeply disagreed on management styles. In corporate law, narrative intent matters immensely, and those diary entries made the plaintiff's case look less like a concrete legal violation and more like a grievance over control.
Ah, so it's a personal grievance, not a legal breach.
That's how the market sees it.
Hmm.
Therefore, the market is betting heavily that the nonprofit to for-profit shift, no matter how controversial it was in the media, will ultimately be upheld as legally permissible.
That makes perfect sense. I mean, they are betting on the strict legal definitions of a breach of mission, and the evidence simply isn't crossing that specific legal threshold in the eyes of the crowd.
Exactly. But we have to remember, this trial isn't over.
Right. The odds are at 39%, not 0. And Sam Altman is expected to testify soon.
Which is the massive wild card keeping this particular market highly volatile. At 39%, the traders acknowledge Musk is currently losing the narrative, but Altman's testimony is going to be subjected to intense cross-examination.
So anything could happen.
Yeah, a single contradiction on the stand, or maybe a newly revealed email regarding that corporate shift, could instantly swing those odds back over 50%. The prediction markets update tick by tick. They basically treat legal testimony exactly like a company's quarterly earnings report.
That is wild.
Yeah.
While Musk's past might be bleeding capital in an Oakland courtroom, but those exact same traders are taking their money and aggressively betting on his future in orbit.
The SpaceX markets are just going crazy right now.
Let's look at the sheer volume of capital moving through there. Because while the courtroom drama captures the media headlines, the massive liquidity is flowing into entirely different sectors. There's a massive surge in volume on the poly market contract asking, will SpaceX IPO by June 30?
And the numbers there are pretty definitive.
Yeah, right now traders are assigning a 61% probability to a June listing. But the valuation forecasts attached to that event are what really stand out to me. An overwhelming 90% of traders forecast that the closing market cap of SpaceX will exceed $1 trillion.
Which is already huge.
Huge. But then there is a 58% probability that it hits $2 trillion. Now, wait a minute. A 58% chance of a $2 trillion valuation, that is astronomical. I have to push back here.
I figured you might.
Is this just fanboy hype bleeding into the financial markets? Or is there a tangible mechanical infrastructure play that justifies putting that much capital on the line?
It is a vital question, because anytime you see a $2 trillion valuation attached to a 58% probability, I mean, skepticism is absolutely required. To understand if this is hype or substance, we have to look at the plumbing of the prediction markets themselves, specifically where this money is actually coming from.
Okay, where is it coming from?
We are currently witnessing what analysts call a supercycle of liquidity. While SpaceX is a high-profile market, the actual liquidity king on these platforms right now, the engine driving the most volume and freeing up the most capital, is the NBA playoffs.
Wait, the NBA playoffs. I am struggling to see how day trading basketball games connects to funding a $2 trillion valuation for a space exploration company.
It sounds totally disconnected, right? But it comes down to capital velocity. Think about the life cycle of a trader's dollar on a platform like Kalshi or Polymarket over, say, a 24-hour period.
Okay.
Just round 2 of the NBA playoffs alone has generated over $231 million in cumulative volume. On Polymarket, traders are heavily backing the Oklahoma City Thunder to repeat as champions at a 61% probability.
Makes sense. They're a strong team.
Yeah. And over on Kalshi, there are these high-volume buzzer-beater markets for individual games, like the Detroit Pistons versus the Cleveland Cavaliers Game 5 tonight. Traders are locking up capital, making very fast, short-cycle bets on these games, and realizing their profits within hours.
Oh, I see. So they win a quick bet on a basketball game, their account balance swells up, and now they need a place to put that money.
Precisely. That sports betting provides immense rapid-fire market liquidity. A trader who just made a 15% return on an NBA game doesn't usually withdraw the cash back to their bank. They look for a medium to long-term market to park those winnings.
And SpaceX is that parking spot.
Right. That liquidity bleeds over into massive financial forecasting contracts like the SpaceX IPO. But to validate your pushback, no, it is not just the overflow of sports betting artificially inflating a meme stock.
So there is real substance to that $2 trillion number.
Yes. A $2 trillion market cap requires the expectation of new monopolistic infrastructure. Traders aren't valuing SpaceX as a rocket company. They are valuing it as a sovereign utility.
Meaning they aren't just a delivery service taking satellites to space. They own the roads, they own the gas stations, and they control the real estate up there. They are establishing the foundational layer for an entirely new economic domain.
That is the exact mechanism driving the valuation. The market is pricing in the fact that SpaceX will dictate the terms of trade for low Earth orbit for the next century. And our sources highlight a very specific high-probability milestone that proves this infrastructure play is already in motion.
Right, the data tracking what they're actually preparing to launch. There's a trending niche market asking whether SpaceX will launch a space-based data center in 2026. And the crowd is assigned a 44% probability of a Starlink-modified satellite prototype launching by December of this year.
That's coming up really fast.
Extremely fast.
Yeah.
And here's where it gets really interesting. We are looking at the intersection of the two most capital-intensive tech trends of the decade: artificial intelligence and space infrastructure.
It's the ultimate crossover.
Right. Putting AI data centers in orbit theoretically solves the massive problems of energy consumption and thermal cooling, which are, the biggest physical bottlenecks for AI expansion down here on the ground. It's like we are literally building the brain of the future up in orbit.
Floating right above us.
But while that brain is being built in the stars, the physical bodies down here on Earth are placing bets that they will lose their livelihoods to it.
It is a striking dichotomy, and the macroeconomic data completely supports that narrative. Prediction markets aren't just forecasting the success of technology, they're actively pricing in the societal friction that the technology is going to cause.
The numbers on this are incredibly sobering. According to Kalshi, there is a trending macro market tracking whether U.S. unemployment will hit 9% before 2030. Right now, it sits at a 51% probability.
More than half the market.
Over half the market believes we are heading for 9% unemployment in the next 4 years due to the rapid automation of service jobs. How should an everyday listener interpret a 51% chance of 9% unemployment? Because on its face, that sounds like a terrifying forecast for the American worker.
It does sound terrifying, but if we connect this to the bigger picture, we have to view this not just as a gloomy prediction, but as a financial utility.
What do you mean by utility?
Well, in market terms, this 9% unemployment contract is functioning mechanically as a hedge.
Okay, break down the exact mechanics of that hedge for us. How does an everyday listener actually utilize a market like this?
A hedge is essentially an insurance policy designed to soft land a portfolio during a crisis. Let's say you are a listener who holds traditional investments, maybe an S&P 500 index fund, or maybe you work in a sector that is really vulnerable to automation.
Like data entry or customer service.
Exactly. You see that 44% probability of space-based AI centers, and you recognize a severe localized economic risk to your own livelihood. The traders buying yes shares on 9% unemployment aren't hoping that millions of people lose their jobs.
They aren't just betting on misery.
No, rather they are buying financial protection. They are taking a small amount of capital and betting on a negative macroeconomic outcome. If AI displacement does trigger massive job losses and traditional markets suffer, their standard investments will tank.
But the prediction market hedge will pay out significantly, offsetting those losses.
Exactly. It softens the blow.
It is crowdsourced insurance against the very technological future they are helping to fund. That is the absolute definition of institutional realism. We are moving past the glossy magazine covers praising the magic of AI, and the crowd is actively pricing in the cold, hard economic fallout.
Real money demands real realism.
Exactly. But the story doesn't end with U.S. labor anxiety. While the markets are bracing for long-term economic friction in the West, they are simultaneously pricing in a wave of short-term, rock-solid economic stability on the other side of the planet.
We see this so clearly in how global capital is digesting the massive democratic exercise that just concluded in India.
Yes, the prediction markets were heavily focused on the state election results over there, functioning as real-time barometers for global stability. And before we dive into these numbers, I want to add a very strict disclaimer.
Always important with politics.
Crucial. Just to be absolutely clear for you listening, we are not endorsing the BJP, TVK, or any political party across the spectrum, left or right. Our job here is strictly to report on how global financial markets are digesting these electoral outcomes.
Just looking at the data.
Exactly. We're looking at this purely as a mechanism of economic data, remaining completely neutral on the politics themselves.
That is a crucial distinction. The prediction markets do not deal in political ideology. They deal in the probability of policy continuity and legislative friction.
So let's look at the data highlights of what the markets are calling the saffron sweep. The BJP secured a historic win in West Bengal, taking exactly 207 seats, and they retained their hold in Assam.
A very decisive outcome.
And down south, in Tamil Nadu, the markets tracked a massive debut from Actor Vijay's TDK party, which took a blockbuster 108 seats. The traders are viewing this TVK performance as a permanent shift in Dravidian politics, basically establishing them as a top-trending third force.
Which shakes up the usual dynamic.
Right. So what does this all mean? If you're a listener right now, perhaps sitting halfway across the world, how can you use these highly specific local political markets as macroeconomic indicators for your own understanding of global stability? Like, how does a 207-seat victory in West Bengal actually affect the global financial ecosystem?
To understand that connection, we have to look at the mechanics of the political risk premium.
Okay, what is that?
Fundamentally, global financial markets hate uncertainty. Whenever a major economy undergoes an election, foreign investors and domestic corporations tend to freeze their capital. They demand a higher return, a premium, to compensate for the risk that a new government might, say, drastically change tax laws, disrupt trade agreements, or just create regulatory instability.
So uncertainty acts like a tax on investment.
Exactly. The higher the uncertainty in the prediction markets, the higher the political risk premium, which drags down overall economic growth.
They're essentially pricing in the anxiety of the unknown, and that anxiety is expensive.
It is incredibly expensive, but watch what happens to the capital velocity once the results are clear. Because the BJP secured a decisive 207 seats in West Bengal and maintained their hold in Assam, the legislative question marks just evaporated.
The market got its answer.
Right. The crowd moves instantly from who won to what happens next. The prediction markets absorb that definitive seat count and translate it directly into economic certainty. The risk premium deflates entirely.
Oh, wow.
Yeah, that is exactly why our sources show the Nifty 50 India's benchmark stock market index holding incredibly strong stabilized support at 24,120.
The anxiety evaporates, the premium drops, and the broader financial ecosystem stabilizes because the rules of the road for the next few years are now locked in.
And the hyper-efficiency of these markets means they really don't dwell on the past.
They just move to the next bet.
Yep. Traders in Mumbai and Pune aren't celebrating or mourning these specific election results anymore. The capital has already moved on. The high-volume political markets are already shifting focus to the 2026 Maharashtra Assembly elections.
They are already looking ahead.
Specifically, they are tracking the potential economic benefits of center-state coordination. They have completely digested the reality of the present, stabilized the stock market, and are already pricing in the friction of the future.
It really is an incredible ecosystem when you step back and look at the whole board. Let's recap this journey of institutional realism we took today. We started in a California courtroom, basically stripping away the philosophical hype of Elon Musk's OpenAI lawsuit.
Where his odds tanked.
Right. We watched the crowd assess the strict mechanics of fiduciary duty, dropping his odds of a legal victory to a grim 39% based purely on the nuance of corporate intent.
And then we followed the money.
We saw the mechanics of capital velocity in action, as traders took their winnings from high-volume NBA buzzer beaters and parked them into a 61% certainty of a June SpaceX IPO, fueling this massive supercycle of liquidity that predicts a $2 trillion sovereign aerospace monopoly.
A monopoly that carries a 44% probability of launching AI data centers into orbit before the end of this year, which is essentially building the infrastructure for the next century of computing.
Which casts a very real, very dark economic shadow back down to Earth. We saw how traders are utilizing these platforms to buy insurance against themselves, pricing in a 51% probability that the U.S. will hit 9% unemployment by 2030, just to hedge their traditional portfolios against AI displacement.
And then we went global.
Right. At the exact same time, we saw how those exact same market mechanics signaled deep structural stability in the East, translating 207 seats in West Bengal into a deflated political risk premium and a rock-solid Nifty 50 index.
It perfectly illustrates how these crowdsourced platforms compartmentalize global risk. I mean, the collective mind can be incredibly bearish on U.S. labor stability, entirely dismissive of a tech billionaire's legal grievances, wildly bullish on orbital infrastructure, and deeply confident in emerging market stability, all functioning simultaneously.
And entirely stripped of emotion.
Exactly.
For you listening, this is exactly why we dive into these specific sources. These numbers aren't just trivia you bring up at a dinner party. They aren't just gambling odds. They are a real-time, crowdsourced forecast of the structural reality of the world you live in.
They really are.
Watching the tape on these prediction markets is quite literally a way to see the future before it arrives, completely stripped of the PR and the spin.
But this raises an important question, one that isn't explicitly in the data we looked at today, but is absolutely critical to consider as platforms like Kalshi and Polymarket scale into multi-billion-dollar ecosystems.
What's that?
Well, if these crowdsourced prediction markets are becoming the ultimate, undeniable arbiter of truth for everything from complex corporate trials to massive global elections, at what point do these markets stop merely predicting the future and start actively shaping it?
Oh, that is a wild thought.
Right. If a CEO or a politician logs onto a platform and sees their success probability plummeting in real time, do they drastically change their behavior just to appease the traders?
Like a feedback loop.
Exactly. If the market assigns a 90% probability that a startup is going to fail, does that metric alone cause institutional investors to pull their funding, thereby guaranteeing the failure? It is a well-documented financial concept called reflexivity. As these prediction platforms transition from niche data points to mainstream financial utilities, we really have to ask if they are still just a mirror reflecting our reality or if they are becoming the engine actively driving it.
That observer effect is a brilliant and slightly terrifying thought to leave off on. Are we just passively forecasting the future, or are we locking it into place the moment we place the bet? Thank you so much for joining us on this deep dive today. Keep questioning the data, keep looking for the real mechanical incentives behind the daily headlines, and we will catch you next time as we continue to explore the wisdom and the immense power of the crowd.